I'm going to talk to you about how the FX market worked, what the fixes were and how they were set, and how traders attempted to manipulate the FX fixes. These slides need to be viewed in context. We have imposed penalties on these firms for systems and controls failures. Those failures made the misconduct by traders possible. As you can see on this slide, the FX market is absolutely massive. The daily average volume turnover of the global FX market was over $5 trillion in April 2013, according to the Bank for International Settlements 2013 survey. And to put this in perspective, you can see on the right how the size of this market compares with a few other key markets on a daily basis. The global bond market, $272 billion, the global equities market, $216 billion, and the New York Stock Exchange, $49 billion. The word fix is market speak for an FX benchmark. In these cases, we are talking about two of the most widely referenced fixes, the 4 p.m. WM Reuters fix, or WMR, and the 1:15 p.m. ECB fix, which are fixed in two different ways. WMR fixes happen throughout the day, but the most widely used is the 4 p.m. fix. The 4 p.m. WMR fix is calculated by reference to trading activity during a 1-minute window or fix period, 30 seconds before and 30 seconds after 4 p.m. The 4 p.m. WMR fix rates are then published shortly thereafter. This diagram gives a hypothetical example of what the WMR fix might look like, where the purple shaded area represents the 1-minute fix period and the blue line represents the trading. The ECB fix is different because it is a snapshot of the market at a moment in time, which is 1:15 p.m, and this is what the diagram shows, that instead of having a fixed period, we have a single point in time. Why do people want to trade at the fixed price? The Financial Stability Board's September 2014 report on FX benchmarks said that asset and other money managers want to ensure that their FX trades are executed at the same price as the fix. That eliminates any tracking error. Prior to a fix, clients often place orders with a firm to buy or sell at a specified volume of a currency pair at the fixed rate. Obviously, at that time, the future fixed rate is unknown. By agreeing to transact with clients at a fixed rate that is yet to be determined, the firm is exposed to rate movements at the fix. So as you can see here, the risk passes to the firm. A firm will typically buy or sell currency in order to manage this risk, for example by trading in the market or netting off, for example where a firm has a buying interest for the fix and trades with a market participant which has a selling interest. So in this example, the client wants to buy a currency pair and the firm is agreeing to sell that quantity of the currency pair to the client at the fixed rate. What this means in practice is that the firm with this buy order will make a profit if the average rate at which it buys the currency in the market is lower than the fixed rate at which it sells to its clients. There is nothing wrong with a firm which is legitimately managing its risk, making a profit through trading at the fix. One of the issues in this case is lack of control over the chat rooms used by traders. Many firms have now imposed restrictions or outright bans on the use of chat rooms in certain circumstances. Traders use chat rooms to share information about the fix orders, to determine their trading strategies, and to attempt to manipulate the fix. This slide gives you a flavour of what these chats were like. Have a look at the blue boxes, which are some of the names the traders used to describe themselves: the players, A team, one team, and the three musketeers. Then look at the yellow boxes and how the members of the chat rooms described how they operated. A three-way relationship built on immense trust. Don't want other numpties in the market to know, but not only that, is he going to protect us like we protect each other? How can I make free money with no f***ing heads up? Cheers for saying you were same way, helped me go early. I'd prefer we join forces. Perfect, let's do this, let's double team 'em. Each of the final notices has a worked trading example in it of behaviour around the fix, which was able to happen because of the firm's inadequate controls over its G10 spot FX voice trading business. We have prepared some slides which demonstrate this visually using the material from the notices, which we think helps make it clearer what was going on. An example of RBS's involvement in this behaviour occurred on one day within the relevant period when RBS attempted to manipulate the WMR fix in the sterling-dollar currency pair. On this day, RBS had net client sell orders at the fix, which meant that it would benefit if it was able to move the WMR fix rate lower. Remember, the WMR fix is set based on trading during a 1-minute fix window. Because RBS is a seller, it will benefit if it can move the fix rate down. Let's look at what the traders were saying to each other ahead of the fix. Firm A is selling 200 million sterling at the fix. RBS responds, "Blimey," judging by lick today, which was an observation that this was a large order in light of the day's liquidity. Another of Firm A's offices needs to sell 100 million sterling at the fix. RBS also has 80 million to sell at the fix. Firm B needs to sell about 60 million at the fix. Firm C needs to buy the same amount of sterling at the fix as Firm B was selling, and they agreed to net off these orders. RBS now needs to sell more than the 200 million at the fix that Firm A needed to sell. In a separate chat room involving 3 further firms, RBS said, "We're getting a lot Betty at fix." Betty is a slang term commonly used in the FX markets for sterling dollar, which is short for Betty Grable, which rhymes with cable. Firm A tells RBS that it has netted off part of its net sell orders with 2 other parties outside the chat room, but that it still needs to sell about 140 million sterling at the fix. This is an example of Firm A clearing the decks. What we mean by that is traders with net orders in the same direction as the desired rate movement at the fix, netting off these orders with third parties outside the chat room, thereby reducing the volume of orders held by third parties that might otherwise be transacted at the fix in the opposite direction. Remember, because RBS is a seller, it will benefit if it can move the fix rate down. The chances of success would be improved if RBS and other firms shared information. Since RBS and Firm A each needed to sell sterling at the fix, each would profit to the extent that the fix rate at which it bought sterling was lower than the average rate at which it sold sterling in the market. This graph is a hypothetical example demonstrating this. The blue line shows where the market is trading, the green dots show RBS's trades, the green dotted line shows RBS's average price, and the dotted purple line is the fixed price. The gap between the fixed price and RBS's average price represents RBS's profit. In the period leading up to the 4 p.m. fix, RBS increased or built the volume of sterling it would sell at the fix via a series of trades conducted with other market participants. RBS commenced this building after Firm A's disclosure of its 200 million sterling net sell orders. Ultimately, RBS had net sell orders of 202 million from clients. It built the volume of currency that it needed to sell at the fix to 399 million sterling, well above that necessary for risk management. In the 10 minutes immediately before the fix window, RBS sold a total of 167 million sterling and Firm A sold 26 million sterling. Together, they accounted for 28% of all sales on the Reuters platform during this period. The sterling dollar rate steadily dropped from 1.6276 to 1.6233. These early trades were designed to take advantage of the expected downwards movement in the fix rate following the discussions within the chat rooms described above. 8 minutes prior to the fix, Firm C commented, "Nice job, gents." During the 60-second fix window, RBS sold 182 million sterling, which accounted for more than 32% of the sales in sterling dollar on the Reuters platform. RBS and Firm A together accounted for 41% of the sales in sterling dollar on the Reuters platform during the fix window. During this period, the sterling dollar rate fell from 1.6233 to 1.6213. Subsequently, WM Reuters published the 4 p.m. fix rate for sterling dollar at 1.6218. Let's see what they had to say after the fix. "I don my hat. Well done, lads. What a job. Bravo. We f***ing killed it, right? 1.6218. Nice. RBS's trading in sterling dollar in this example generated a profit of $615,000.